When you look at some of these things, we heard from the Commerce Department with this report about the chips, electronic chips. They don't think that problem's going to get fixed anytime this year, and that's going to mean high prices for things like autos, where the supply has been down. So we just haven't had enough supply to keep up with demand. Stuff like medical supplies. I just feel like they're going to have to keep an eye on that. And by the way, maybe there are other things they could do. Maybe the Fed could do these rate hikes at the same time they start bringing some of the liquidity down, shrinking the balance sheet to some extent. But even that, I mean, that's like the big unknown factor. We know it helped on the way up, and it definitely inflated a lot of prices. We don't know what the equivalent of, we know what a quarter rate hike does. We don't know what the equivalent of taking $1 trillion off the balance sheet does. And that's going to be something to kind of behold in the markets, too.
So I think that's right. And by the way, we know when you put the liquidity in what it does to nominal GDP, and we saw that. But you got to think about there's some symmetry to it, i.e. you're going to start to really pull back on nominal GDP. And listen, I think there's something that's really important. I think that when you were, I think the Fed could have tapered and tried to land the plane a bit softly into where we are today. And listen, it didn't happen for whatever reason. It didn't happen. It didn't land the plane softly. However, dropping the plane out of the sky, breaking it, and putting it in reverse can be really dangerous because you can shock nominal GDP down. Listen, there are a lot of people who can enter the workforce today. You can get that participation rate higher. The Fed still is, we could talk about how hot the labor market is today, and it's super hot. But there are more people who can enter the labor force. There's no reason to destroy the recovery to try and alleviate when quite frankly it's very tangential as to how much interest rate can impact inflation, particularly when it's on the supply side. So my only point being, get to neutral, and it's a two-step process. Get to neutral, pause, see where you are, and interpret how much more you have to go. But I think a lot of people in the markets have said, gosh, we got to skip getting to neutral, we got to go right to tightening. And that I think has to be modulated somewhat with let's get to neutral and see where we are. And that takes a period of time. That'll take months to get to neutral.
Let's talk about what this means for investors, because this is what everybody's trying to figure out right now, given the week and given the month that we've started the year. What do you do right now? You think that there's going to be a lot of volatility to come. We've come down a long way, but you're not convinced that this is the time for long-term market holders to kind of jump in and buy. Why is that?
So, I think the volatility is still there. Listen, I think at the core, you have to think about, we could debate the pace at which the Fed's going to go. Listen, we're in a tightening regime. Whether that's from emergency easing to neutral, it is still, you've got to think that interest rates are going to trend higher. We're probably, I think we're going at 2% 10-year, maybe a bit higher than that. By the way, I don't think we're going much higher than that. But we're in that sort of framework. So volatility is going to be higher. By the way, you've got geopolitical situations, which you all have chronicled, that we've got to keep an eye on. And you've got an economy that's starting to transition in some areas a bit. So being a bit conservative. And when you're investing, you think about, okay, what are the things that are working for me? What are the hedges that I have? Interest rates aren't a great hedge to risk assets today. The dollar, tricky in terms of is that a great hedge? So what do? You've got to be a bit careful, run more cash in your portfolios. But then part of what we were doing the last few days is think tactically, gosh, what has really gotten beaten up? It's a pretty aggressive move down. And what has gotten beaten up? Listen, I think the year will still end with equities higher. And you think about, okay, so where have you compressed things enough that you just start to put some money to work? All along the line, though, of, God, I got to run a moderate beta because the volatility is still going to be high. And managing the risk around that is not easy. And the liquidity in the markets, given the lack of conviction, is the lowest I've seen in a really long time.
When you say you think the markets will end the year higher, you mean higher from here or higher than where we started the year? Because there's a big difference.
So fair point. I think higher than where we started the year.
Okay.
Listen, I still think, and I don't think it's that hard to get there when you think about the dynamics. I still think earnings growth this year, if you're going to have, let's say you have a 7-ish% nominal GDP, what are corporate revenues? Let's say they're around that number. You take operating leverage, stock buyback, it's not that hard to get to 13 to 15% earnings growth. You lift the discount rate a little bit, you compress the multiple a little bit. Can you have an equity market that still ends the year, up significantly from where we came into the year? Yeah, I think so. I don't think it's that the valuations would be that high. By the way, when you take equity risk premium today, and you look at where it was when inflation was high in the 70s and 80s, it's actually very generous relative to those periods of time. So could you have equity risk premium pick up a little bit? Yeah, I think so. But boy, I think earnings are going to, like we saw yesterday, I think the earnings will be good enough, Not like last year, but they'll be good enough to propel the market to still a good year. I just think you got to be careful in the next couple of months.